Today we will be discussing about what is an account. Now, in the earlier class I had told you that what is the meaning of the subject of accounts, and basically what it discusses about. We have also talked about the basic concepts of accounts and the foundation on which accounts is based. Now, what is an account? Actually, account is nothing but it is a place where transactions of the same nature are recorded. Actually, in accounting we keep a separate record of each and every type of asset, each and every type of expense, each and every type of liability, capital, as well as revenue. So we need to record them at a particular place. So all the additions to it are recorded in one place, and in the same place on the other side all the deductions to it are also recorded. That place is known as an account. For example, if I tell you that we make a cash account, that means that is the place where all the transactions relating to cash will be recorded. So whenever cash comes into the business, it is recorded in one side, and whenever cash goes out of the business, it is recorded in the other side. So we get a true picture of the cash transactions, as well as we can also say, as on a particular time, what is the amount of cash that the organization is having. So account can we simply write it as A/C, that is the abbreviated form of an account, and it is nothing but a record which is kept for each type of your asset, expense, liability, capital, revenue, etc. Now accounts can be of two types, personal and impersonal. Now, personal accounts are accounts of natural persons, artificial persons, and representative persons. Like, what are natural persons? Natural persons are like human beings. So, all human beings' accounts will be natural persons. For example, Ram's account, Sham's account, John's account, and so on. So, any natural person will be a human being's account. So in any business we have debtors as well as creditors, and they may be human beings, so they are natural persons. Artificial persons are the accounts of all joint stock companies, firms, partnership businesses, and so on. That means they represent a natural person or a human being. For example, say if I write BCCL's account, if I write Reliance Industries account, they are all artificial persons, because in the eyes of the law, a joint stock company is also regarded as a human being, which we have discussed earlier, and that forms the basis of all accounts. And representative persons are those accounts which represent somebody, and it can be any outstanding, that is O/S I have written, that is outstanding. Outstanding means something which has become due but has not been paid. For example, say you are staying in somebody's house on rent, and you have stayed there for 2 months but you haven't paid the rent for 2 months. So that will be outstanding rent. And accrued means any income which has become due but has still not been received. So any outstanding accrued expense or income account will be a representative person. For example, say outstanding salary, okay, that represents the employee to whom salary has become due but has not been paid. Or say outstanding rent, that represents the landlord. The landlord in whose house you are staying, you haven't paid his rent, so that is a representative person. And then impersonal accounts again are of two types, real and nominal. Real accounts are accounts of all your assets, For example, we have cash account, building account, furniture account, goodwill account. They may be your intangible also. So real accounts can be tangible as well as intangible. Tangible assets, as I told you, they have a physical presence. For example, cash account, building account, furniture account, they are all tangible real accounts. And intangible real accounts are like a patent account, building account. They have value. They are things of value, but they do not have a physical presence. And nominal accounts are accounts of all expenses, losses, incomes and gains. For example, we have a salary account, discount account, rent account. These are nominal accounts. So in personal accounts are of two types, real and nominal. And personal accounts are of three types, rather there are four types, but now we will not discuss that. We will discuss only three types: natural persons, artificial persons and representative persons. Now we come to what is known as double entry. Like in double entry, there are two aspects of a business transaction. One representing what is known as debit. In short, we write it as DR. And the other representing credit. In short, we write it as CR. And in every business transaction, the total of the debit will be equal to the total of the credit. Okay. So, in double entry, we follow certain rules, and by those rules we write the business transactions. So, in the rules of the personal accounts they are also known as the golden rules, that we debit the receiver and we credit the giver. In real accounts, the rules are debit what comes in, credit what goes out. In nominal account, the rule is debit all expenses and losses, credit all incomes and gains. These are very, very important rules. That's why they are known as golden rules. So whenever a business transaction occurs, we write them following these rules. That in the case of personal accounts, debit the receiver, credit the giver. For example, say Ram is the receiver, so I will debit Ram's account. And Sham is the giver, so I will credit Sham's account. In real accounts, debit what comes in. For example, the business buys a furniture, so the furniture is coming into the business. We will debit furniture account, and we'll credit what goes out. For example, say the business sells furniture, so we will credit furniture account because it goes out. In the case of nominal accounts, the rules are debit all expenses and losses and credit all incomes and gains. So for example, we have expenses in any business organization, like salary is paid, salary is an expense. So we will debit salary account. Rent is an expense. We debit rent account. Similarly, we will credit all incomes and gains. For example, sales takes place. That is our income. So we will credit sales account. For example, discount they receive. So that will be credit. For example, they receive rent. So that will be credit. So whenever any income or gain is there, we credit that. And we debit all expenses and losses. So these are the rules that we will follow in double entry to write all our business transactions. Now, according to the American system, this was the traditional. These are the traditional rules, and with these rules we can write all business transactions. But according to the American system, there is an easier way of writing the debit and the credit. In the American way, all the types of accounts are classified into 5: assets, expenses, liabilities, capital, revenue. So we have discussed about them. You know what are assets, things of value, expenses. Then liabilities, something which you owe to somebody. For example, a creditor is your liability. Capital, you know, that represents the account of the owner. And revenue means any type of income. Okay. For example, sales account, that is a revenue. Now, according to the American system, In any business organization, assets plus expenses will be equal to L plus C plus R, that is liabilities plus capital plus revenue. Now you try to remember this particular equation, that assets plus expenses is equal to liabilities plus capital plus revenue. And according to the American system, whenever an asset or expense increases, we debit them, and whenever asset or expense decreases, we credit them. And the right hand side, what we have, L plus C plus R, that is liabilities plus capital plus revenue. When they increase, we credit them, and when they decrease, we debit them. So this is also very, very helpful in writing the business transactions. I repeat that once again, that whenever an asset or expense of the organization or business entity increases, we debit that asset or expense account. And whenever an asset or expense decreases, we credit the asset and expense account. Similarly, whenever a liability, capital or revenue increases, we credit them. And whenever a liability, capital or revenue decreases, we debit them. For example, if we correlate it with the golden rules, for example, when I purchase an asset, say I am purchasing a building, so the building is increasing, we can say, so we will debit the building account. And according to the golden rules also, building is a real account, it's a thing of value, so debit what comes into the business building, so I will debit building account. Similarly, say I buy a furniture, so the furniture is increasing, furniture of a particular value is increasing, so I will debit furniture account according to the American concept. And here also, if you follow the golden rules, now furniture is a real account, so here the rule is debit what comes in, so what comes into the business? Furniture, so I will debit furniture account. Now let's take an expense, say salary, we paid salary, so salary expense increases, so according to the American concept, since the expense increases, I will debit salary account. And according to the golden rules, salary is a nominal account, it is an expense account, so it is a nominal account. So here the rule is debit all expenses and losses, so I will, since it is an expense, so I will debit salary account. Now let's take liability. Let's say a creditor, you have purchased goods on credit from somebody. Say you are purchasing goods on credit from, say, Ram. So Ram is what? Personal account. So according to the golden rule, debit the receiver, credit the giver. Who is the giver over here? Ram is the giver. So I will credit Ram's account. And Ram is my liability because I have to pay him money. I have purchased goods on credit from him. So my liability of the business is increasing. So according to the American concept also, we will credit Ram because L plus C plus R, that is liabilities, capital and revenue. When they increase, we credit them, and when they decrease, we debit them. So Ram is a liability because we are purchasing goods on credit from him. So liability increases, so I will credit Ram's account. Similarly, capital. Now capital is given by whom? Capital is given by the owner. Now according to the business entity concept, I told you that the business and the owner, they are considered as two separate entities. So it is assumed that the business is borrowing money from the owner. For example, started business with cash. So started business with cash, who is giving the cash? The cash is given by the owner. So owner's account, I told you, it is capital account. So according to the golden rules, owner is a personal account. He is a person who is giving the money. So credit the giver. He is the giver. So I will credit the owner's account. That is, I will credit capital account. And according to the American rule, your capital increases, when the owner gives capital, the capital of the business increases, so capital account is credited. Similarly, revenue. Say sales takes place. Sales is a revenue. Now sales is a income. So according to the golden rules, sales is a nominal account. In nominal account, credit all incomes and gains. So I will credit sales account. Okay. And according to the American rule, you see revenue increases. So I will credit the sales account. So whenever liability, capital and revenue increases, we credit them. And whenever they decrease, we debit them. And when the assets and the expenses increase, we debit them. And when they decrease, we credit them. For example, let's take an example of a decrease in asset. For example, sold furniture. The business is selling furniture. So furniture is a real account. So what goes out of the business? Furniture. Credit what goes out. So I will credit furniture account. And according to the American concept, also we see that asset is decreasing. So when the asset decreases, we will credit the asset. Okay. Similarly, your expense also same way. When it decreases, we credit them. And the opposite will be for the liabilities, capital and revenue. So this forms the basis of writing the business transactions. And the manner in which the business transactions are written, that we will study in our next video. And that is known as the journal entry. So the journal entry is the technique in which the business transactions are written in a book which is known as the journal. So in that particular book, that is the journal, the business transactions as and when they occur, they are written in chronological order. So that means as per time basis, they are written. And we follow these rules in writing those journal entries. Either we follow the golden rules or we follow the American approach for writing these journal entries. And the book in which it is written, the journal entries are written, they are known as, that is known as the journal. And they are written in a particular manner which we will learn in our next video. Okay.